Hello everyone. Hello. Thanks for tuning in today. Thanks for joining some of you guys on the YouTube channel and a bunch of you guys on the Zoom link. Thanks for tuning in. I We've been working on this new webinar series this month. Like 2026 is bound to be, I think it's bound to be a really exciting time for startups. And if you're trying to raise money in this AI era, there are a few things that have changed versus how raising money used to work. So I want to talk a bit about those. I want to make sure that you don't make the same mistakes that I did. So let's go for it. We have a bunch to cover. We'll have time for questions. You can throw them. I'm decent at multitasking, so I have the YouTube chat here and the Zoom chat here. So if you want to throw a question and it's easy, I'll catch it. Otherwise, we'll leave it to the end. Hey, Nikki, just to make sure that Nick, just to clarify, it is live. Sometimes people ask and think this is some sort of recording. Anyway, my name is Caya. A lot of people think that I'm Slidebean because of the YouTube channel. That's not the case. I'm just the CEO of this company called Slidebean. Before I get that question, this webinar has been it's been about the recording for you guys on Zoom. This webinar is actually live streaming to our Startup Club channel. This is like our secondary channel where we nerd and really dig deep into startup related topics. So if you would need to rewatch, that's where it's going to live forever, at least until we come up with a new one. For you guys on the YouTube link, then you're just on the YouTube link. Okay. And also, like I said, we've prepared a bunch of webinars this week, so a good way to stay tuned, even if you can't attend the live sessions like today. I love when there's a big live audience because we can do a lot of questions and stuff. But if you can't, you can subscribe to the channel. The webinars will stream there. We also have a bunch of videos and a bunch of good content around it. So, good. Okay. So the only reason I understand this is because Slidebean, well, we're this platform for founders to navigate fundraising. We raised money. We're a venture-backed company. We raised money. I hated this process. And we kind of set it up on ourselves to try to make sure that you don't suffer as much as we did with our raising. I really think that raising money sucks. It's probably to me, it's the worst part of being a founder. As a founder, you want to run your company, you want to, build your product, you want to see revenue and happy customers, and you have to deal with all these investor people. So how does that go? I think that for me, the biggest struggle with the whole fundraising was this. Like when we were raising our first round, this app called Yo, I found the article back there. This app called Yo, this is 2014, raised $1 million because it just sends messages back and forth saying yo. And you hear about these funding stories and you're like, well, if they raise money, then I'm ready, right? Like then my company is ready. But that there's always more to it, right? Or in this day and age, you see these AI valuations in the billions. Ilya, the CTO or former CTO of OpenAI, raised $1 billion for a new company just right off the bat, right? Just that's it probably with a pitch deck and a name. But for the most part, that's not how it works for the rest of us. So the best advice I can give you on startup press and on startup valuation references is just don't pay that much attention to them, because the reality is that a lot of funding happens because people have connections and because people are decently connected, and or have a real baggage, like a lot of companies under their belt and a lot of trust from previous investors. And that's what really defines these crazy, sometimes pointless rounds that are kind of too big. But for the rest of us, for the other 99% of us that don't have exits under our belts, or that aren't raising money on hype, then this is for you. This is for the rest of us. Okay. First thing that we want to understand that I want to make sure that you guys understand is that funding is a means to an end, right? It's not the end game. It feels a lot like the end game because we have to spend so much time working on it, and because getting money in the bank for companies feels like security, right? It feels like peace of mind, and then we can kind of get working on it. But it's not the goal, right? It's just a step, right? It's just a means to an end. The end game of your business is by all means either selling your company or going public, right? An IPO. Now that begs the question, okay, like, well, what about profits? Is that ever the goal? Is that ever the goal of a company? Is that ever the goal of a startup? And the answer is loaded. Let me give you an example. Okay. So let's imagine that you've done your math, you figured out that you want to start this company and you want to raise something like $1 million, right? That's not a crazy amount of money to raise for a pre-seed company. Great. So you go on, and the way you think about it is, well, maybe investors are going to get 15% of my company. I'm going to give investors 15% in exchange for $1 million. That that doesn't sound too crazy. Okay. And then you go and let's say that you raise this money, investors get 15% of the company, and you go and you start using this money, you build the product that you want to build, you launch it, and it goes well, and your company grows to say $10 million in annual revenue, which sounds great. It is great. I mean, it's by no means a small feat to build a $10 million company. Um, but well, okay, so what happens next, right? What about these investors? Well, if your company makes $10 million and you're looking for profits, what's going to happen is, well, you're probably going to operate on an EBITDA, that's your earnings before interest taxes, of about a mil of about 10%, right? That's pretty standard, even for software companies, at this smaller scale. To make 10% of your entire revenue to be clean net income profit. But after that, you have to pay taxes, of course, right? So that's going to be about 20%. So from 10, you're going to go to 8% in net income. That's around $800,000. So what happens next? Well, you share these dividends, right? You may choose to, most companies would, and it's like, okay, let's pay out dividends to ourselves, the founders, the shareholders, and to the investors. And in exchange for that, well, they get their 15%, right? So they get that 120K, 15% out of the $1 million pool. Sorry, after tax, out of the 800,000 pool. So let's remember they invested $1 million, which means that it would take about 9 years of doing this again and again, 9 years of $10 million in revenue with 10% EBITDA to pay investors back, just to pay them back, just to get them back to the $1 million that they invested originally. And that's not very exciting for an investor because a lot of things can go wrong in 9 years. And moreover, like, when am I getting as an investor, when am I getting any profits back? Like, I invested, I just got my money back, but what about turning a profit on this risk that I made by investing in this company? So that's not the way startups work. It's not. I always like explaining that example, showing that example, because so many companies I talk to, or founders that I talk to, they're thinking of their companies like that, right? They're thinking of $1 million. They're pitching this idea that they're never going to raise money again. They're going to be profitable and they're going to pay dividends to their investors. But that's not exciting for investors because it takes too long. It's a lot of risk. It's very little reward over too long of a period of time. So that's not the way startups work. Let me paint you another scenario. Let's say that this company needs, same idea, needs to raise $1 million, and it's thinking about giving investors 15% of the company. Now, but this company is not going to focus on profits. It's going to focus on just growing really fast. So what are they going to do? Well, because they're growing really fast and they're not profitable, they'll need another round of investors. So that means that everybody's going to get a little bit diluted, right? You're going to have to give some percentage to the new set of investors. And then another set of investors, probably, right? So that initial cut that investors got was down to 10%. Also, the founders cut, but I'll get to that. So these guys invested $1 million. Now they end up with only 10% of the company. Okay. What happens next? Well, because this company is very aggressive, right? It's trying to grow really aggressively. It's not focusing on profits. It's just reinvesting all this money and this extra money that they got from the new batches of investors. Well, this company might hit maybe $50 million in revenue. No, it's not profitable, but it hit $50 million in revenue and it was able to get there really quickly. Okay. When you are there, right, when you're this company that's growing, that has $50 million in revenue, then you're exciting for a bunch of other reasons more than your profit. Maybe you're excited because of the tech, maybe you're excited because of the team or because of the audience or because somebody else can monetize your customers in some other way. And there's a good chance that a bigger company you'll find the attention of another bigger company that might say, well, actually, we'd like to buy you, right? We'd like to acquire you because we like your team, because we like your tech. We think there's a synergy. So they might pay, and this is I'm not making this up. They might pay something like 5 times your revenue for that acquisition. That's the way exit valuations tend to happen. Okay, so they'll pay 5 times five times what the company what the company made in revenue. That's $250 million. Um, so, that's for that investor that got 10%. Well, that's $25 million. And that is a great ROI. That is an insane ROI. That's a 25x return in a small span time, maybe 7 years, which is mad, right? Um, that's the game that investors play. Investors don't want, they're not going to risk $1 million invested into your company that might fail in exchange for just getting it back. They want a multiplier. They want this money to be multiplied. And that comes with its own set of problems. It's super risky, first of all. This company might fail at any time because if it doesn't raise the next round, it'll fail. It requires this super fast growth. It means the company is not going to be profitable for a while. It means that it's going to need more investors. And the only way these guys will make their money back is if there's an exit or an IPO. It's the only way. So whenever you hear a founder talking about not raising, I want to raise money again. I only need one round. I don't want to raise again, or I want to turn profitable, or I don't ever want to sell my business. Those are big, big red flags to an investor because how are they going to get their money back with profits? It just takes too long. But honestly, fuck investors a little bit. Like they're a means to an end. Funding is a bit means to an end. What about us, right? What about the founders? So let's see that example of the founders. Honestly, not fuck investors. Investors and they take risks in our companies and they help us get to where we need to be. But we have to think about ourselves. Okay. What about founders, right? In this example I gave you, like this slice of funding for founders is way smaller, right? These founders, they don't even have 50% of the company, right? This pie got reshared. Well, the first thing we have to change a notion about how we think about equity, which is that startup equity doesn't work in necessarily in pies. A better representation of this would be bricks. And let me show you how that looks. I actually came up with a little example for you guys. Okay, so I'm going to show you screen in the right place. I think you guys can see this, hopefully. Yeah. So in Slidebean, all of your accounts include this section called Startup Equity, which has a cap table. So cap table is basically the tracking system of all of your equity. And the reason why we put a cap table into our platform is so that you can forecast or can think, start to understand about equity. Ideally, you want to use this cap table to track your equity. Important, like the cap table or this cap table is really just a representation of the of the agreements between the founders and the shares. The real cap table is in your legal documents, in your equity issuance. Like your lawyers have the legal paperwork that backs this. This is not the legal part. This is just a summary, right? A summary that you can use to to take a look at and to forecast and so on. So here in settings, you can define, for example, your founders. And notice that here, when we define founders, right, I'm going to set myself Caya, and I'm going to do Anthony there from the Zoom link. So both of us are founders, and Anthony. Yeah, both of us are founders. And what we do, that when we set up this business, we set it up with a certain number of shares. Each of us got, say, 5 million shares in the business. And because the company has 10 million shares total, right, we each have 50%, right? So 50% of this pie. Now, when we go and add funding rounds here, let's say that we raise the pre-seed round, and we set this funding amount to, say, $900,000. That's actually a standard. In 2025, the median pre-seed round was $900,000. So I'm not making that number up. We have to define a valuation. Let's assume this is equity. It's going to convert to stock. We can do a convertible note too, but that's a video for another day. We have a video about that. But let's say that we set a valuation of $5 million. What's actually happening? What's actually happening here? Well, in the cap table, what's actually happening is that the shares that Anthony and I haven't changed. We still have 5 million shares. What we've done is the company has issued these 1.8 million shares to these pre-seed investors. So now they have 15% of the company. But notice that we didn't give out any of our shares. It's not that me or Anthony, we took some of our shares to give it to them, or that we took some of percentage to give it to them. That's not the way it works with equity, at least in C corporations in the US. And this system is actually great because that allows us very easily add new investors into the mix. So let's add a new investor into the mix. Let's bring in a seed round, and let's say that we raise a seed round a few months or years later, and this seed round is $3.6 million. That was actually not 35, 3.6. Sorry, that's actually the median seed round that startups raised in 2025. Obviously fed by a lot of this AI hype and so on. So with this $3.5 million funding round, let's say that we have a valuation of $50 million for that round. That's just a placeholder, but just for the sake of example. Notice what happened here, right? So the shares that I have, the shares that Anthony has, and the shares that these pre-seed investors have, those have not changed. The shares that they have, it's the same number of shares. What has changed is that we've created new shares. So the company now has more shares and the percentages change. And that's the big difference with equity, right? It's not that we are reissuing shares between people. We're not selling shares. Part of the reason, and I see your question, Anthony, on the taxable income. If I go and sell my shares to an investor, I'm actually getting money for that, which is taxable income. And here, the investors are buying shares; they're investing in the company, so there are no tax implications for raising money. That's actually one of the reasons. Good question. So notice that this pie got redistributed. It now looks very different from before, but your percentage got diluted. That is exactly right. And it's important that you understand this because how much dilution will a founder need to go through, right? Through this lifetime of a company. So let me get back to my slides. Now, by the way, this cap table example that I used, it's in our platform. You can sign up here if you're on the on the YouTube link, you can sign up there. Maybe if you're on the Zoom link, maybe you're in our platform already. But just grab that link there. My team will paste it on both ends if you want to copy, and obviously you can play around with your numbers. Okay, but let me give you an example of how this might look for a founder. And this, I don't think you guys are going to like this slide, but it's a very real slide. This is the amount of equity that the founding team, so think of the founding team as both Anthony and I, right? Both co-founders. Think of the founding team, the amount of shares that the founding team has at different funding levels. Take a look at a seed round, right? Not even pre-seed, but seed. The median company, or the typical set of founders altogether held 56% of the company. That means that by seed, you've already created enough shares and diluted yourself to 56%. Investors own the other, what's that, 44% of the company, which I'm sure blows a lot of people's minds because you all think, oh no, I'm gonna own my company, I'm gonna have control, I'm gonna have that 51%, and I'm never gonna give it away because I make decisions and nobody can fire me. But that's not the way it works. That's by no means the way it works. Look at Series A, right? By Series A, the typical set of founders, not even one individual, but both or three of them together. So if you have three founders in this example, Series A, not example, actual data, real data. You have three co-founders. Basically, each co-founder in this median Series A company has only about 12% of the company. And that keeps going down, all the way to Series D, right, where all the founders all together would hold about 11% of the company. So why what's up with that? Like, are we building this company that somebody else owns? And the answer is kind of, but that's not all of it. Because let's look at that example, kind of like what we did before with the $250 million exit. If you have 11% of the company, you sell the company for $250 million. Each of you is getting $15 million, $14 million, and you have to pay taxes on that, so it's probably going to be like 10. But that's life-changing money for pretty much every one of us. But that's true. It's maybe not as exciting as what you thought. If you want the real deal, and you're probably looking at $1 billion exit if you're a unicorn. right? That is transformative money. But the point is the end game, right? So going back to funding being a means to an end, the end game of all this stuff is not holding on to this company forever, is not collecting dividends, is for the investors and for the founders to build a company, to sell it quickly, and to either retire or take this money and build another company. That depends on how much of a serial entrepreneur you feel with. But that's those are the stakes. I've seen some comments, Anthony, Andre, and some of you guys on YouTube. Maybe I'll do a little pause now and kind of read a little bit through those questions. I have more slides, but let me go through your questions. Yeah, so the spreadsheet, I mean, so the template that I share lives in Slidebean. It uses some functions in our network. So it's not an Excel. It's built on top of Google Sheets, but you have to use it from the platform. Series D between 50 and 150 million, 100%, pretty good return for it. Yeah, that's exactly right, Andre. You're onto it. The scale is best to use debt once founders hit a certain level. Is it better to use debt? I mean, sometimes. At a certain stage, companies can raise money with debt. It has its caveats. But yeah, it's an option. True. Is it normal for a company to give up to 31% of its shares in the seed funding stage? It's more than normal, as it seems, right? Again, this is consider this as the median. A seed round of $100,000 where you have to give out 40% of the company. That's a lot, right? We're thinking seed rounds. Think of seed rounds in the scope of what a seed round looked like in 2025, which was 3.5 million in the median. When should you be raising in terms of your first round? I'm going to get to that. Yeah, so I'll get to what's next. Okay, so how do we go about raising money, especially in this AI day and age? Last question I see, Angela, can't investors just cash out? Normally they can't. Normally a good company rule book, that's called the bylaws, will forbid founders and investors from selling their shares randomly to other people, because you don't want that. You don't want somebody else to own your shares and control the company. Right, and it can get a little messy. Normally we all cash out together. That's the objective. We either all cash out together if there's an exit, or we all cash out together if we go public. But there's no cashing out in the middle, and that's it's a commitment. But anyway, okay. So we said funding is a means to end. We established that we need to go through multiple funding rounds to do this. And then so a standard tech company will go through rounds in more or less in this order. Pre-seed to seed to Series A to Series B. To your question, Gabby, will this be on YouTube later? It's actually live streamed on our Startup Club channel. So I'll ask my team to paste that link again if you guys want to subscribe and tune into all the webinars we're doing this month. But okay, so pre-seed to Series B. And to this end game, right? But what is a standard tech company? Let's just establish what that is in today's day and age. So standard tech company obviously has a path to scale. We have established that the $10 million, the one that gets stuck in $10 million is not an exciting venture backable company. This is a company that needs to scale a lot faster. So a lot of scale, unicorn, but hundreds of millions of dollars in revenue. Important is you can only really do that if you're a product, not a service, right? If you're a service, or if you need humans, or if you need a staff to scale alongside your revenue, right? That doesn't really work so well. And then in terms of that AI, like if you're using, to the question of AI, well, if you're using existing AI models, you're also a standard tech company. If you plug into OpenAI, ChatGPT, or using some existing model to automate some work and some stuff in your company, by all means, consider yourself a standard tech company. You could brag all you want about being an AI product. That varies in success, but in the end, we're all in the same boat. Like AI, for us founders and for companies and for products, AI went from being this edge that you're like, oh, like we're building on AI, woo, valuation multiplier, to saying that's like, yeah, like everybody can access this API, right? It's no longer a big differentiator. So that's a standard tech company. Most tech companies are standard tech companies. And when would you raise money? Like what milestones? What do you need to hit in order to raise these rounds? The first thing I'll say is, okay, a seed round, which we've been talking about. Normally, a company would raise a seed round when they hit around $30,000 in monthly revenue. When they hit it, that's when you can go get in front of an investor and say, hey, we're raising a seed round. We're raising $3.5 million as a seed round. That's pretty standard, 30K in monthly revenue. This is for, I'm thinking software SaaS, where a lot of this revenue is profit, right? Your product doesn't cost a lot to operate. If you're kind of like a marketplace where you have 30K in volume, but your revenue, like what you collect is just, I don't know, 10% of that, then that number is probably a lot higher. But that also, hopefully corrects a misconception, which is, when do you launch, or what happens when you launch? You should launch somewhere between your pre-seed and your seed, which means that if you launch and you try to raise money when you launch, you're in a really, really bad time to raise money, because investors, a lot of fundraising is about FOMO, right? You want investors, you want to get in front of an investor and say, hey, we're building this. It's growing really fast. It's a really exciting company. It's going to be a unicorn. And if you don't invest now, my valuation is going to be triple in 2 years. So I mean, you might as well get in now or not, right? And you want to create that FOMO with investors and saying, yeah, like take my money. I want to invest. I don't want to miss out on this huge business opportunity with this incredible founder I just met. When you and you can do that, right? At pre-seed, when you have revenue and you're growing, right? It's not just getting to that revenue, it's getting to there fast. When you're pre-seed and you're growing, you can make that argument. But when you just launched a product and you don't have any customers, you don't really have an edge, right? When you launch and you're waiting to get customers, maybe you don't have revenue. I'm sorry, you don't have funding or capital to go and deploy and get customers. Well, then how do you create FOMO with that? Investors can just go and say, oh, I mean, it looks exciting what you're doing. It looks, I like you. Let's get on a call 3 weeks from now and see how you're doing then. And if 3 weeks from now you haven't grown, then there's no FOMO, right? They're not missing out because you're stuck, right? So that's, raising money right after you launch is a really, really bad position to be in. That's why you want to, and this is really important. You want your rounds to last until you hit the next milestone, right? Because if you get stuck between these milestones, then that can get really complicated. So another common milestone is, say, $2 million in annual run rate, right? So that's normally the milestone you have to hit to raise a Series A. That's what, 860, 170K in monthly revenue. That's when you can go in front of a Series A investor and say, hey, I'm raising a Series A. Let's talk about it. Okay, but all this time I've been talking about a standard tech company. What's the other kind, right? That's the other kind of company. I like to call that type of company the R&D tech company. It's a little, the big difference, right? It's obviously, again, a product that can scale a lot. It's a product, it's not a service. The big difference between R&D and standard is that this R&D tech company is building some deep technology that requires a lot of R&D. Maybe you're building a new LLM, right? So like Ilias company, the former OpenAI co-founder, they're obviously an R&D tech company. They need a lot of money before they can get this product out. They're building things from scratch, right? Biotech is another good example or your medical technology where you need to go through clinical trials, right? So it's millions, tens of millions of dollars before you can get any revenue, right? So they don't play by the same rules. Hardware is another example, right? You have to develop this prototype. It's a lot more capital intensive because before it can launch or before it can achieve anything. Now I always add that note. It's like, if you're building deep R&D, probably there are some patents and or some PhDs in your team, right? It's very hard for me. I'm a digital animator, right? I studied filmmaking. Right? It's very hard for me and masters in engineering to go out and raise a deep R&D tech, raise money for a deep R&D tech company, because we don't our products, we could plug into other open AI products, existing APIs, and there's another path. Normally, what I'm trying to say is, an R&D tech company has no other path other than raising all this money. There's no alternative path. One, it's obviously a little riskier, and the reward needs to be really big. But more importantly, most of the R&D tech companies I see have either very experienced founders that can get away with raising all this money, or they're kind of built on top of patents or on top of universities or like PhD research. Look at the original OpenAI engineers, right? Many of them were PhDs. Okay. So yeah, and the idea is that these companies, they don't operate on the same types of rounds, right? The milestones are very different. And if any of you are on that, I'd love to know. Put it in the chat. Because we don't get that many in our YouTube channel and in our email lists. But anyway, let's go back to the standard. I guess most of you are probably this kind. Yeah, so the important part here is you want to raise money, that gets you from one milestone to the other. I see you, sports medicine. Yeah, same for you in the sense that you have to make sure that you raise money from one milestone to the other. What those milestones are, it varies a lot more in R&D tech companies, but for standard tech companies, those milestones are actually pretty clear. So let's go through those. I think that's the best tool I can give you. I can give you the milestones that you guys need. So what are the milestones to raise a pre-seed round? This is before seed, right? This is before revenue. This is the round that gets you from pre-seed to seed. That means that launch is in the middle, right? So when you would raise a pre-seed round, when you have a fully formed team, when you have founders that have all the core skills to build this product, and when you have a good understanding of how you're going to get your first, I want to say 100 customers, but let's maybe say 100 customers or your first 100K in revenue, right? You have this path to accomplish that, and you know how you're going to accomplish it. And again, the money that you raise at pre-seed, median in this AI area was 900,000 at least last year, for a pre-seed. This money must last until the next round, right? You have to stretch that money until you get to the next fundable milestone, which is seed. So what's that milestone? We talked about the 30K in revenue. Obviously, there's a product in the market. You should be growing at 10 or more monthly, maybe 10, 20% month over month. And you should have this basic understanding of growth metrics, right? Why? Because the seed round is going to feed that fire. It's going to get you more customers. So you need to understand where those customers are coming from. I always like to point out like red flags, like what would stop you from raising a pre-seed round. And I see a lot of founders in this roadblock, right? If you, for example, are trying to raise a pre-seed round so you can recruit your last co-founder, you're not a pre-seed company. The team must be formed by people who believe in this, regardless of the money that's been raised, or in other words, this team gets formed. Think about it, the story of Airbnb, right? These three guys got together. They scrapped, they bootstrapped, they hustled a little bit, got a little bit of money, but they were all together before the company made any money, and they probably worked on it for months. Maybe they had day jobs, but they worked on this thing, for months before the company could raise any money. That's the type of team that you're looking for. If you're not being able to recruit someone because you don't have money in the bank, you're pitching either the wrong person, somebody who's too risk averse, or you're just not selling your company right. That's the first test, I think, as a founder. Can you sell your company to someone else that joins it because they believe in this product so much that they want to build it with you, not because you're paying them for it, not because they're unemployed and they got a job. That's not the way you found that co-founder. And investors know that, and that's why they rarely, if ever, fund solo founders or founders who again are raising money to recruit somebody that's key to the company. No idea how to the customers, right? Sometimes you see all these pitches where founders are just pitching how they're going to build a product, but they have no idea how they're going to get customers. You should have the answer to this question at pre-seed, again, because the money that you're raising now has to last until you get to seed, and you need to have that plan figured out. Yeah, so that's pre-seed to seed. Let's do another jump. Let's do the seed to Series A, right? So we know where we are at seed. How do we go from seed to Series A? Like when we raise a seed round, that money, the 3.5 million median, needs to be enough to get you to Series A. So what's Series A? We talked about the $2 million in annual run rate. That money should last until you have some traits of product market fit. At that point, you should have a fantastic understanding of metrics, and you should have started to establish a good dynamic of team ownership and delegation, right? At that point, this is one big test thing. How much work can you offload from the founders? How much ownership can you find people that can own other tasks so that the founders can focus on the stuff where they're better at, rather than a company that's too founder dependent. Yeah, some red flags that would not allow you to raise a seed round. You launch the product, but you have no revenue. Talked about that. Or a common mistake in pitch decks is that company will go and our founder will go, they'll pitch the company and say, oh, we're raising money for 18 months of runway. Again, the months of runway don't matter so much. What really matters is getting to that milestone, right? Is being able to afford getting to Series A. If you're going to run out of money before you hit $2 million, then you're going to be in a catch-22. Okay. Now, for those two stages, like that's I think where we've helped the majority of companies. We haven't counted this in a while, but the last time we checked, I think it was 500 or 600 million dollars that companies had raised using some form of our platform, either a pitch deck builder, or an investor finder, or cap table, or our financial models. Like our platform is kind of built to help companies navigate all this mess. So a bunch of tools. Again, we have like 20,000 investors in our database. It's not that we'll introduce you to them. It's just that we'll save you the time of having to go and find them online. We have some good filters for them. The financial model, so you can budget all these rounds. Obviously, the pitch deck builder, which was our very first product. Probably the best way we can help, and I see a couple of you guys asking, is like we have this plan called Slidebean Accelerate, where our team actually gets involved with you, right? So Accelerate includes one-on-ones with our pitch deck team, one-on-ones with our financials team, and it includes 2 strategy calls with me over the course of a few months. It's just $99 a month, so we're kind of try to price that compatible with founders so that we can be of assistance. These strategy calls with me, we first do like a group call with a small group, usually like 5 people, to kind of get you on board. I send you over to my team. You can work with our pitch deck team and our financials team to get that stuff ironed out. And then, 2-3 months later, after our team kind of approves and make sure that your pitch deck is in the right place, we can do a one-on-one again to kind of get into the nitty-gritty of how you're gonna phrase that to investors. So if you think that we can help, grab that QR code. My team's gonna paste that link in both of our streams. Okay, let's do one more, and before I jump to questions, let's do one more, which is Series A to Series B. I've worked with a couple of companies that have gone in those steps, like Series A and Series B rounds. And this is what I've observed. If there are any Series A, Series Bs in the audience, and either all of you should be going on this path, so this should be useful, right? So again, it's a milestones thing, right? So when you raise a Series A in this day and age might be 10 million, $8 or $10 million. That wouldn't be weird. We have the metrics that we hit to get to Series A, and this money that we raise, should allow us to probably to 2.5 to 3x our revenue, right, over the course of a year and a half, right? So it's another multiplier of revenue. With this Series A money, it's $8 to $10 million. You should be able to hire this senior executive team, right? So that during this period, you should be able to steal really talented people from other companies that are in your space, because essentially this is the team, or this is the core of this team that's going to take this company to the next level. And that's when you finally have the money, the credibility to start building this insane, powerful executive team. And by Series B, like during this process, by Series B, you should have what I call early traits of an exit strategy, right? You should have a notion of whether your company is going to raise a Series C, D, E, F, or if it's gonna and then IPO, or if it has an exit within the horizon, right? And if that's the way investors are going to get their money back. Founders sometimes in early decks they have a slide called like exit strategy. I honestly think it's kind of a useless slide, because early pre-seed and seed, like nobody knows what your exit strategy is going to be. A lot's going to change over the next few months and years. So I don't think it's worth kind of spending too much time talking about it or speculating about it. But by Series B, you should have an answer to that question. Okay, some red flags, right? Stuff that wouldn't allow you to raise a Series A. Not enough revenue. That happened to us. That's a story I tell sometimes in our videos. We raised our seed, and we raised our seed, and we got stuck between seed and Series A because somebody told me I had to raise 18 months of runway. I did. And what I really had to raise was enough to get to Series A. And we couldn't get to Series A. Luckily, we were able to, flip the switch, turn profitable and survive. But most companies don't. And that's yeah, so don't let that happen to you. So you run out of money before reaching the milestone again. Or just not understanding growth metrics, which is probably the last thing I'll say on this slide. Uh, I I've talked to too many Series A companies and Series B companies that don't really understand their metrics. They have a Series A, they're raising an $8 million Series A round, and when you ask them, okay, like what's your customer acquisition, like how much, what's the ROI, like how quickly can you turn $1 million in marketing or sales spend into $3 million in revenue? And they don't have the answer to that question because they haven't been tracking their growth correctly. So that's common. Make sure that at this point you should understand your metrics very well. Probably the best example, one of my favorite examples, is this company called Upkeep. I actually, this is an earlier Slidebean, but I actually wrote like 80% of their pitch deck. I don't take any credit for their round. Like they raised their round because they were a fantastic company. But I got a glimpse into the metrics and the way through companies like this, I've had glimpses into what Series B looks like. And with the pitch decks of Series B companies that we've worked on, there's this big shift in how you pitch a company, right? And at pre-seed and seed, at pre-seed, you're pitching this dream, right? You're pitching a dream of um, uh, this fantastic team that can build this fantastic product. At seed, you're pitching the potential for growth, right? This product is launched, it has revenue, you can show that revenue, and what you're pitching is like, give us money so we can just put more fuel into this insane fire that we've just started. At Series A, things start to get a little bit more analytical, right? At Series A, people are not only looking at revenue, they're looking at, oh, how quickly did you get here? How efficient is your team? Can you manage the pressure of going from, managing, so far by Series A, you've managed maybe $4 million in capital. Now you're going to manage twice that in 2 years. Can you do that correctly? So a lot of Series A turns into that team question. Obviously, looking also at the potential for scale of the business, because at that point there should be good indicators of retention, low churn that show that your business is up to growth. But after Series B and after Series C, in the pitch decks that I've seen or either worked with, companies that I've worked with on either one of those stages, the story changes a lot because those pitch decks are much more about financials. They're much more about honestly, a lot of it is just proving that you understand these metrics, showing some incredible forecasts that you made with a solid financial model, and saying, hey, like, we know that if we raise $36 million now, what that's going to translate is into this. And at the end of that capital, we'll be ready for an exit. And this is what the exit's going to be like, because we think that these three buyers who maybe we were already talking to are gonna flip the switch. Like that's the story as rounds evolve. It's much less about the founders at that point. It's much more about yes, honestly, metrics and and those exit fundraising strategies. Alrighty, guys, those are all my slides. We still got like 15 minutes left for questions. So let me stop the screen share and go start scrolling up and down. If you found this useful, again, we'll paste links to our platform. Feel free to give it a shot. But let's get to questions. Okay. We are pre-seed, however, we have an MVP and customers, pilots, and validation. We've spent $16 million to date to manufacture a product. Now we are out of stock and need to build around 2,000 units with more coming. I don't know, some conflicting stuff here, because you say you're pre-seed, but you've spent $16 million to date. Is that your own money, you bootstrapped? If you have revenue, if you sold this inventory, you could be looking at other financing options like loans. But my thinking is, yeah, I mean, if you sold all this inventory, it looks like you kind of qualify to be a seed company, or at least to pitch seed investors. That's what I'm thinking. Let's see, Joseph, what do the funding rounds look like for R&D tech? And I mean, normally the rounds are bigger. Normally the milestones are based more on certain patents approved or clinical trials, for example, or building the first prototype, or like sorting out, like the first, say, milestone might be, hey, we've built a functional prototype that works, and we've figured out what the materials could look like and the company that would manufacture it. I think that would be a good milestone, right? Where you would go and raise capital for, say, an initial batch of production. That could be an example. Those vary. I mean, they vary a lot depending on the type of R&D, but that's just an example. Hi, is that a red flag in seed if there's only one founder? Yes, I would say yes. It's not a deal breaker completely, but it's a big red flag. Normally, when there's only one founder, something is weird. Either the founder is not really well connected and they haven't been able to find other co-founders, which would be a red flag, or the founder isn't easy to work with, which would be a red flag, or they haven't been able to convince other people to join them, which is a red flag, right? So all of those are red flags. Sometimes there's a founder that's just really good at it, and they have experience before, and they have the money for it, and they didn't want to shed any equity, and they paid, and they were willing to risk some of their own money, and then they became the solo founder. It happens. But most of the time, when it's only one person, it's an indication of other problems. Also, there's another red flag with solo founders, which is that how are you going to split your time, right? One reality that we have to deal with as founders is that nobody in our companies will work as hard as we do. Nobody. It's an impossible ask. So if nobody's working as hard as you are, when you have three co-founders, you have three people who are working insanely fast or at full speed. But when you're only one, right? Like you depend on employees, and employees will be committed and they'll work for your company and they'll be passionate about it, but they're not going to work as hard as a founder. So I think that's another reason. Okay. How to create investors FOMO at pre-seed? It's harder, right? Honestly, at pre-seed, it's a lot harder. A lot of the pre-seed round is I mean, it's a little bit of FOMO, but it's FOMO about, this is a fantastic team, they have a fantastic idea, but that FOMO on, you don't have metrics to share with, right? So it's honestly, pre-seed rounds are some of the hardest because they're raised on pure passion, man. They're raised on pure grit and founder passion and just being able to convince these guys, or on relationships, right? Which also come from proving that you had passion about things that you do, but before. Another, I see you guys very quiet on the YouTube live stream. If you want to throw questions, I have that too, by the way, but I'm just keeping up with the Zoom people. Can R&D tech startups raise a pre-revenue seed stage if significant milestones have been achieved? Yeah, of course. That's the whole point of R&D. It's like you're millions of dollars away from any revenue because you're an R&D company. I mean, hardware, etc. So yeah, absolutely, you need to raise money. It's almost the only way, unless you're a millionaire. Carrie, our company is pre-seed, but we do have an MVP. Does this hurt us because we're still pre-revenue? Should we focus on selling the founders, or should focus on getting enough customers to get us to the seed raise? Yeah, that's that's a great question, Carrie. Normally, again, we establish what you need to be pre-seed and what you need to be a seed. I think that when you go to an investor and say, we have a product that's ready to launch or that we just launched, that's when that anti-FOMO gets triggered. It's like, oh, I can wait. I'm just going to delay this conversation. I'm just going to push the ball a little bit, kick the ball. I'm sorry, I forgot the expression. I'm just going to push this call, a couple weeks, 3 weeks, and that way it'll give me time as an investor to wait and see what happens with these guys, right? That's kind of the disadvantage that you have when you pitch the fact that you have a product ready or launched. The difference, right? The difference with the difference with an MVP or with a basic prototype is that you can use it as leverage and say, hey, look what we've built. This shows that we have the skills. This shows that we have the right idea. It gives you an idea of what this product might look like, but it's not ready. We're still 5 months away from launching this. And the only way we can launch it is if we raise this round, right? And that kind of kills that anti-FOMO situation, because you're basically saying we can't get to the next stage unless we raise this money. If you stall, if you don't want to invest now, then don't. Fine. But we need this round. We need this round now, and it's the only. And if you don't invest, other investors will, and they'll be the ones that get this early valuation because we're pre-revenue on this really exciting product. That's kind of like the cart that you want to play. I've even told companies that if if you think that your MVP is ready, like it's ready to launch, don't tell and you're raising a pre-seed, don't tell the investors because it's shooting yourself in the foot. You can say that the product is earlier, maybe that you have some early beta testing, but the closer you get to launch or that notion of launch, the more you're going to have that stalling of, hey, oh yeah, I'll just wait and see what happens with traction, which again, if you need the pre-seed round, it's not going to help. Okay. Bunch of questions, guys. Good stuff. Vincent, we're licensing our core AI tool. Should we raise funds to build and replace it or concentrate on profitability using the tool? I don't know if I understand your question. Um, you're licensing your core AI. I mean, I'm assuming you're using somebody else's API. I mean, if you want to, I mean, taking a step back, like it's a common misconception that you have to build everything yourself, right? It's a really common misconception. You might be tempted to it, right? And say, oh, we can build this instead of paying these guys $500 a month. We can build this ourselves and just do it ourselves. Well, yeah, you could, but but that's also a distraction, right? Like building your own product, maintaining your own product is a huge distraction. And you want to, focus all of your time, which translates time is money, right? Translate all of your time slash money into the stuff that you do best and the stuff that nobody else can do and the stuff that gives you an advantage, right? If building an AI model in-house to replace the API that you're using, is it going to make your product orders of a magnitude better? Yes. Okay, then that's the core premise of your company. If it's only going to save you a little bit of money, then focus on growth. Right? That's what I think. Okay. Hi, company is pressed. Hi, my company is pressed. We had a soft launch, and the company generated 30K, but the company is liquidated now 6 months after. Can I mention this when we want to say we've tested and raised 30K in initial revenue, or we should leave it out? I mean, you can brag about some sales. Um, I wouldn't put you in the seed bucket, right? In the seed box with 30K of revenue in the past, right? It should be 30K of consistent monthly and growing revenue, right? But yeah, to include or not include founder's salary as part of the pre-seed. If you can get over the hump of development and HIPAA assessment, yeah. So founder's salary is a good question, man. Like, it's such a taboo topic, honestly. If you're, I mean, people need a salary, man. Like people, as founders, you are allowed to pay yourself. That's part of the reason why we raise money. Um, founder salaries should be part of any round. That's just nobody's gonna raise any eyebrows on you getting a salary from the money, because you need to live, right? Otherwise, you're spending from your own savings, which basically you're spending more money into the company than then that's not being tracked, right? So by all means, founders should take a salary. Now, how much is that salary? It should not be even close to what your market salary is. It should not be close to what you made before you quit your job to work in this company. It should be less than that. Why? Because the benefit of your company is in the stock, right? And the exit that we talked about, in the carrot at the end of the stick, right? That's what investors want. They want the carrot to be that exit because that benefits everybody. They don't want you to collect a huge salary early on and just live chill, right? That's not the investors don't want you to be in that position. I've seen it. I've seen pitch decks where founders put starting salaries of 300,000 a year, which is just insane and stupid, honestly, because there's no place in the world where that'd be a fair founder salary. Um, Man, it should be the salary should be. I'm stealing this quote from someone, but the salary should be just enough, so that money is not a distraction for you. Um, it should not be enough for you to save money. That's because that's not what we're into. It should just be barely enough. It should be probably less than many of your employees at early stages, because again, you get equity and they don't, right? And yeah, so don't be afraid to pay yourselves. Just don't come up with madness numbers for it. Okay, I have a call at the half hour. Sorry. But I'm getting to as many questions as I can. We're sending this one here. When talking to investors, is it expected to mention that you want to exit the company at some point? Is it an unspoken agreement? Yeah, I think it's mostly an unspoken agreement. Don't ever say we want to be profitable and I don't want to sell this business, because that's not what a VC at least will expect to hear. Will this Zoom be recording on? Yep, it'll be on the YouTube channel. Again, on the YouTube channel, I mean, here on Zoom, by the way, wherever you found today's webinar, I'm curious where, by the way, that's going to help my marketing team a lot. So if you can type either webinar, I'm sorry, either newsletter or app, maybe you found it on sign up, or maybe you just found it on YouTube or social media. If you can type any of those, that'd be really useful to our marketing team to figure out what worked best. But we are going to have one a week every Thursday through March, all different topics. So be sure to subscribe or you tune in, or keep an eye on the new ones coming. A bunch of different topics that we're covering. Okay. What investment vehicle would you recommend for a pre-revenue, about to launch, SaaS, trying to become a lifestyle business and avoid VC? Trying to raise 100K from friends and family and potentially 200K from angels. You're contradicting two things, right? Because lifestyle business is scenario one in our examples. The 10 million that only pays dividends, that doesn't exit, and that takes too long for investors to get their money back. So that's incompatible with investors, not just with angels or VCs. It's incompatible with investors, or with most investors. If you need 100K, or if you need 300K, you should figure out it's a big range, right? 100 to 300, that's a big range. But whatever money you need, and if you don't have it, and if you need to raise it, you have to come up with a structure that works. Again, we talked about scenario two. That's the typical tech startup, but if you're a scenario one where it's a company that's a smaller market where you don't want to sell, the only way in which you can make this an exciting case for potential investors is if you give them half the company. That's it. Think about, I always give the example of a restaurant, right? A chef can't start a restaurant without the executive investor. An executive investor can't start the restaurant without the chef. They're both indispensable to each other, but the restaurant is not a SaaS business. It can't become a unicorn. It's only going to make $1 or $2 million a year. I don't know. So what do? Well, they split it 50-50, right? That's it. That's the bargain, right? That's the compromise that these guys have to make. The other person needs half the company so that it's an exciting opportunity. But if you're a small business, or if you're not going to scale too much, the share of the company that you have to give to investors is much bigger, because otherwise it's never going to be exciting for them. Okay. Curious what the current landscape looks like right now with AI companies and investors. We have a really good video on this. I wanna find it and paste it for you guys. Hold on, let me get it. It's the video that we published last week. I did a little study on like what kind of cycle of fundraising we're on. I wanted to talk more about it, but I just didn't have time to fit it in the slides. But that's the link to that question. Really good video on like what's happening now with funding rounds. Make sure you're trying to get more questions. Any thoughts on raising safes versus price rounds? Yeah, like safes are great. We also have a whole full video on that. You can check it on the channel. Safes are great. They're great. They save a lot of money. They save a lot of time. I didn't talk about them today because it's complicated. But no, I mean, it's complicated to explain, and it wasn't the purpose of this session. But yeah, safes are a fantastic alternative to priced rounds for sure. Along the lines of salary question, if I am being brought in as an external CEO, having worked for large companies, the founder immediately feels like he doesn't have the skills to run the business and he wants to innovate. Does the same rule apply to bringing in an external CEO? Yeah, I think that, in this, I guess it depends on how much they're paying you, right? Like if you have, for example, a founder that's a technical co-founder and they reached out and they have a product idea, but they don't know how to talk to investors, they don't know how to market, and they reach out to me, which I know that's the two things I do. I think I know how to do. And they're like, hey, like I want you to come in and do these things for this company. What do you want? Like, I would say like, well, I think I'm almost as important as you, if not equally important as you. So maybe I should get 50% of the company, no salary, or like equal terms of salary, and 50% of the company, because we both need each other. You have the product and the skills to build it. I have the skills to sell it and to fund this business. So it sounds like a fair exchange, right? Where that balance starts skewing is when they say, well, I have a product that's launched and has revenue, and I'm going to pay you a salary and not out of my own pocket. That's very different, right? In that case, I'm an employee. I'm an important employee, but not a co-founder, right? So I might get a little bit of a equity as a perk, And I would expect a little bit of equity. But if I'm not taking that much risk because I'm getting a salary from them, then that changes those circumstances. I see newsletter, YouTube newsletter. Okay, newsletter, Google, direct email, Slidebean site. Okay, sounds like email is what worked. I'll let the team know. Your team makes really great videos. Thanks for those. Thanks for watching, Bill. Yeah, I think we're at time and we're at questions. So thank you guys for tuning in. I love having such a big audience. So I'm glad you all tuned in. I hope we have the same audience and many of you tune in for our session next Thursday. Different time, but also in the morning. Bye, guys.